Good morning, everybody. This is Kirk Spano, Investing 2020s, April 9th, 2021. And we're going to talk a little bit about where the market is right now today. Try to really wrap our head around what is next in the stock market. Where are the markets over the last 12 years or so? Since the bottom in 2009, we can see that the places to have been investing have been the US stock market and the India stock market. If you'll notice, the very bottom line is Shanghai, China, commie stocks. So for all the talk about commie stocks and wanting to get in on China, it is proven to not be the best place. And why is that probably? Well, despite having the biggest growth on the planet, according to them, they lie, cheat, and steal when it comes to capital markets. This is why I stay away from commie stocks. And I throw that out there over and over again because people want to tell me about Tencent and Baidu and Alibaba. And Alibaba was the only company that I would invest in for a very long time in China. It was my exposure to their developing cloud industry and their consumer trends. And the problem is that once the CEO of that company, Jack Ma, decided to say, hey, maybe the government should start taking a look at doing this or that, the government, made up of the commies, decided to beat him down, made him disappear for a while, dropped a lot. Is that something that you want to deal with? I don't, especially since, as a group, those stocks haven't really done all that well. So why would anybody take so much risk on a dream that never transferred? The Chinese Communist Party, for decades, has been stringing along global investors, promising this big pot of gold if you just invest in us now and let us use your capital and let us take your technology. And while I am not a heartless man, I believe that we should give them certain technology and help them, because you don't want hungry, cold, angry people anywhere in the world, especially those with nuclear weapons and gigantic armies. I don't think that means that as investors, we should be throwing our money over there. There are better places to invest that are friendlier to us and have more established legal systems that aren't based on the whims of a group of people who are really not even elected. I mean, when there's only one party and the party picks the candidates, how free of an election is that? How much can you trust somebody who has absolute power? What do we know about absolute power? It corrupts. So for not the last time, just another time in a string of times me saying, don't invest in the commies. If you have any commie stocks, sell them and invest in something better, more trustworthy. Maybe something in America. For some of your portfolio, maybe something in India. And there's a few other places along the way, some of the emerging markets that have the benefit of younger populations, education, stable or at least mostly stable legal and political systems, maybe some resources of their own. Those are the handful of emerging markets in the world that we're going to want to invest in. I'll be honest, I would love to invest in the Middle East if I didn't think that their political systems could just erupt and be destroyed. Because as we transition to a cleaner world, the fact that they're along the equator and have wealth to build from, presumably could have education for all and build good workforces, they have the pieces to put together pretty neat, pretty sustainable growth economies. But they'd rather fight with each other. And until that changes, it's hard to invest there, even though they have the foundations of some very good things. So as an investor, I have to look at the whole picture. And I want to manage risk. I did an interview yesterday with Julian Klimachko, who on Twitter is the Spat King, and we'll talk about him in a minute. But one of the things we talked about is how you know where to invest, and then how to manage your investments. He's a pretty big time hedge fund manager in Canada. Invented a class of ETFs up there. And we talked about how the number one thing in making money long term is managing your risk. So when we look at places to invest, while there are great, really just great potential places to invest all over the world, if you can't manage that risk, then you shouldn't take the risk. You can't manage the risk of the commies. You can't manage the risk of perpetual war in the Middle East. Now, if you want to be a speculator and you want to try to be a great macro trader and you want to try to outtrade people like me, and then the few percent of people who are better than me who control massive amounts of money, have at it. But this comes back to our whole argument about why we have to control our emotions, not be arrogant. And I will tell you, I'm going to start showing you some charts here, and a lot of it comes back to arrogance perpetuated by liquidity. A lot of people out there think they're super great investors because the stock market went up. Again, I will tell you the story from back when I was helping my uncle start his firm and my brother was working there. And in the early 2000s, we laughed at people who never have really had much insight, but their investments were going up. We called them bull market managers. When the stock market crashed, 2008, 2009, we laughed at them because my brother and I basically broke even for that financial crisis. And we saw all the other advisors in the office and brokers throughout the gigantic brokerage firm we were connected to at the time with losses of 30, 40, and 50%. And what did they always say? Well, the market went down. There's nothing I could do about it. Well, but how smart are you when it goes up? No value added there. So I hope over the last few years, I've taught you how to pick out better stocks, how to try to understand what it is the market is missing when the market is missing something. On this chart, what the market is missing is that the commie stocks suck. And the commies can tell you over and over and over again, you should invest here because we have this big growing economy based on the numbers that we provide to you. The stock market is more delusional now than at almost any other time in history. And it's leveraged. This is a few weeks old, but it's about the same right now. When you take the averages of these four valuation metrics for the stock market, this is the most expensive stock market in history, nominally. Now, I don't believe it's the most expensive stock market in history. I believe it's second, maybe third. Why? Interest rates. But as we've seen, with interest rates inching up a bit, the market has been doing a lot of jitterbugging, setting little new highs, but not with a lot of conviction anymore. Volume was extremely low this week. What do we know about money flow index versus relative strength? If money flow index turns away from relative strength will follow. Why? Because money flow index takes into account volume, the amount of money in the market. So if money slowly starts draining out of the stock market, as money flow can hint at, that means relative strength will fall off, then price will fall off. And while I think it'll be difficult to go below this line with all the Fed supports out there, I don't think we're going to see these types of numbers again. To get to around here, will only be one standard deviation out of the normal range, right? Because the normal range is from here to here, but normal is a bit different now until it's not. And since I'm not a dollar death person, right? I'm not a dollar bear. I don't think that we're going to get in here. If the dollar collapsed, we would. But I don't think the dollar will collapse. In another interview that I'm doing, I have to actually redo it because we had a Zoom problem. I'm talking to Dr. Sean Stein-Smith with Lehman College out in New York. He's a Forbes columnist. And we talk about Bitcoin and crypto and blockchain and the new digital dollar and what it's going to mean, and how the digital dollar is going to push US Forex reserves globally much higher. So this is the Shiller index. And according to the 10-year PE, we're way up here. So what this means is that we're the second most expensive market in history. And when you think about earnings, I think it's important that you wrap your head around the idea that corporate earnings were juiced up under President Trump because he cut their taxes dramatically. And now, under President Biden and a Democratic Congress, which I told you 3 years ago was going to happen, and I said it would be a 10 million vote difference, ended up being 8 million, you're going to get a tax increase on corporations. And it's entirely justified because you have companies like Google and Apple, Microsoft and Amazon, who are the richest companies in the world by cash on the balance sheet and revenues and market cap. They don't really pay any taxes. Why? Combination of loopholes that they utilize to avoid taxation. And that's why American corporations have the highest paid CEOs, part of a big skim. So now that big skim is going to be a less big skim. It'll still be a big skim. It'll be less big. Those corporate earnings will come down. Probably not much. Single-digit percentage probably. But people will throw a fit. They'll go mental on the far right. You're bought and paid for corporate huckster charlatans will be out there on CNBC in particular and Fox Business telling you how slightly higher taxation on corporations is going to ruin America. Well, I will just point to the 1990s for that and the Obama years. It's just not true. Now, if you believe that we can live on a sugar high forever, I will point you to every little kid who crashed off their sugar high. Can't last. And while I'm not a huge deficit hawk either, at some point when 90% of the population has no realistic chance of retiring with any sort of security, you start to think maybe there's some changes that need to happen. And you start to look at what the election results are, and you start to think there's a lot of people who agree with that. Well, if a lot of people think there needs to be some changes, you have loudmouths out there like AOC and Bernie Sanders, who are probably way too far left for reality. It'll happen. You get your cheerleaders, you get your angst, turns into a type of populism, and it moves the needle. Luckily in America, we have a two-party system, and we stay relatively close to the center. Even when we are to the left or to the right, we're still pretty close to the center relative to the rest of the world. What does this mean for the investor? It means that when an acceleration decreases in acceleration or becomes an outright deceleration, market sentiment changes. When the stock market falls, it usually falls very fast. That's why we call it elevator drops. When the stock market rises, it usually goes on for a pretty long time. That's why over 3/4 of the time the stock market's going up. And that's why we set new highs almost every year, going back forever. That combined with the policy decision that we should have a little bit of inflation. If you've read John Maynard Keynes, you probably believe that's right. I do. You want a little bit of inflation. Just keep making the pie bigger. And remember, in the long run, we're all dead. Although we're working on that. So with this particular ratio, we would expect corporate earnings to probably chop along for a while. And while that wouldn't directly imply that prices should come down, sentiment, right? People will see that earnings aren't going up anymore and maybe take a mini step back temporarily. They will adjust the prices themselves, thinking, well, where the greater fool's going to come from? I don't want it to be me, so I'm going to sell while I can. I'm going to get while the getting's good. So if you're sitting on a 200 or 300% gain on some stock, and you're feeling all giddy and you think you're super smart, I'd like to tell you about a gambler I know. This guy makes six-figure income selling some sort of widget to the fossil fuel industry. And his income got crushed a couple years ago, but it's come back recently, mainly because he survived the head cut counts. The guy makes six figures. He likes to gamble. And he posts on social media his winnings when he wins. He doesn't post his losses. He had a great house in a suburb, 20 acres of land, gigantic pole barn, little mini business storing people's boats in the winter. Lost his house. Played a lot of video poker. He got a couple royal flushes, became addicted. I'm telling you right now that if you're sitting on stocks because they went up and you feel good about it, but you don't really understand that company or the price ratios or the earnings or EBITDA or those sorts of things underlying those stocks, then you're just a gambler that happens to be on a hot streak. You're on a heater that the Federal Reserve created. And as a percentage of the market cap, the Federal Reserve is now putting in less than it did when the market cap was about half of what it is now. So a little over a year ago, the S&P 500 was down around 2,100. Now it's up around 4,100. Federal Reserve's putting in the same amount of money. Think about that ratio. In real terms, the Fed is putting in half as much as it used to, and it's scheduled to start withdrawing that support at some point in the next year or two. Here's another way to look at this particular measure. Only the tech bubble has been more expensive based on average earnings ever. This is the second most expensive market ever, based on what earnings probably will be over a rolling time period. Extremely low interest rates certainly has something to do with this, and I believe the interest rates will stay low. They'll vacillate in a new range that's really been around for a decade now, 12 years now, of low and super low. Probably won't see normal interest rates until the baby boomers are well into retirement and a lot of graves. Pumped up earnings due to tax cuts account for a lot of this, which is what I just told you. So taxation changing will have an impact. And also new investors and leveraged accounts account for some of this. So the millennials that came into the market, then all the leverage that was employed. What does Warren Buffett think about this? Well, by his favorite metric, this is the most expensive market in history. Barely came down on the crash, which is why I showed you those standard deviations. I don't know that we're going to ever see this again. It makes sense that we can get down into this area somewhere pretty easily. That would imply a stock market way into the 2000s, S&P 500 way into the 2000s. So this metric indicates that it's cheaper to start a company than to buy one on the stock market. Maybe this explains Warren Buffett's mountain of cash, which is as big as it's ever been. And maybe this explains why you have all these people with SPACs running around trying to find private companies being public, because the public companies are too expensive. Also, the SPACs also are there because money is cheap. And when money's cheap, people do all sorts of speculative things. Happens over and over and over again. In reality, the 2020 correction should have gone further, but the Fed intervention prevented it. We should have headed back down to 2015-16 levels, and we didn't. We never even got close to the trend line. Look where it got to. Look where we are. Because the Federal Reserve pumped trillions of dollars into the markets. Not the economy, but the markets. A little bit the economy, but mainly the markets through the banking system. What about that leverage? What does the recent hedge fund collapse, a mere $20 billion event, right? In a market of trillions, a $20 billion hedge fund caused Viacom, CBS, Discovery, Baidu, and a couple other stocks drop around 50, 60%. One fund. Now take a look at the margin debt. Just keeps on going up and up and up. And as the Federal Reserve becomes less aggressive, because that's really what it is, they're not outright withdrawing liquidity, they're just becoming less aggressive with the liquidity. At some point, because these lines track pretty close, you'd expect margin debt to come down, the stock market to follow. Happens over and over again. The correlation here is basically 100%. So the only argument you can make is that margin could go up forever. Well, they thought that right here. They thought that right here. I don't know how high it can go. My target for the S&P 500 is higher, but that's a few years out as the economy starts to build from the middle out instead of the top down. If we were going to stay with a top-down economy, then I'd say this could keep running. Had Trump won, I would have expected that. With Biden, I expect some jitterbugging here and some pretty interesting trading opportunities. Here's another way to look at that same chart with it inverted. Every time you get alligator jaws, right? Alligators get hungry. So what's this guy telling you? Telling you that this is exactly right. Based on all their policy, from taxes to how the stimuluses work, everything else, this is right. So we have to keep looking for our opportunities here and here. And the reason I have crypto here instead of Bitcoin, I've been hinting at this for a super long time, finally started saying it out loud a few months ago. The crypto that's coming is going to be the big winner. It's not Bitcoin. It's going to be the crypto dollar. So last summer, when I was telling you to buy Bitcoin, when it was under 10,000, telling you to take a portion of your savings at the bank, put it in Bitcoin, I'll tell you right now, you should sell most of your Bitcoin. You want to keep it at 1% of your savings or 2% of your savings, just so you have the lottery ticket. I get it. But when the digital dollar comes out, it's not going to be 100% tied to Fed policy, Fed counter-cyclical policy. The nature of cryptocurrency is that they're going to have a certain amount, and then some sort of a formula for supplies in the future. It won't just be the Federal Reserve chairman deciding to go click, 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 click. It's not what it'll be. So the crypto you're going to want is going to be the digital dollar. I'll show you a little bit more why than all of these things. And as I've said, I don't expect a stock market crash. I don't think you should go 80% to cash. In fact, I don't think, in hindsight now, seeing what the government can do and the central banks can do, I think it's pretty foolish, actually, to ever go 75% cash again like I did. I didn't get back in fast enough. Going more than about 50% cash is probably too much. There's always something you can invest in. One of the things you can invest in right now are gold stocks, which are dirt cheap. Because gold supply isn't going up as fast as gold demand. And only because of the capital markets is the price of gold not higher. It's been trending, right? It's been chopping along in that range that we talked about quarters ago, a long time ago. If you take a look at a stock like Barrick Gold, you take a look at what their earnings are and the free cash flow and how much they're cutting debt and paying dividends and buying back shares, you go, well, gee whiz. Not going to take much for this stock to run at some point. It looks like it bottomed out about where we said it would bottom out. And now it's been building a base and started to go up in the last week or two. And I like gold stocks, not gold. Why is that? Because you get the leverage of the operating company. These operating companies are in great shape. Commodities are hard to invest in, but you can trade them. Companies are easy to invest in. You make your analysis, you say, I think this is going to look good for the next 4, 5, 6 years. You buy it. Commodities, you have to trade. You're going to trade against professionals. with great resources and experience, and a lot of capital. What I tell you about my poker game, I'm not a bum hunter, but I don't want to sit down at the table where I know I'm not the best player. I especially don't want to sit down at a table where, I think I might be the worst player. Trading commodities is a lot like that. A lot of people who do it full time. Do you want to get into that game with them? Or you want to take your time and find companies that, whether the commodities at the top of its range or bottom of its range, company will still do either good or really, really good or great. That's where Barrick Gold is right now, and most of the gold miners are right now. Whether gold goes down $100 or $200 an ounce or up $200 an ounce, these companies are going to do pretty well. Obviously, they'll do better if the price goes up a couple $100. But in either case, up or down $200 on gold, Barrick and Newmont are still going to do pretty darn good. In tech, and in particular, industry that uses tech, are going to do really well. Big separation between the industries that use tech well and those that don't. And it's coming hard. I'm seeing it at my level. I've got a couple dollars that I'm looking to invest right now into local business and local real estate. And I'll tell you what, the difference between the restaurants that made sure that their websites worked well for ordering out, taking payments, made it easy, they're thriving. There's a guy a couple miles away from us. I forget the name of the restaurant actually right now. Sweet Basil. Now I remember. Sweet Basil, 27th Street, Franklin, Wisconsin. Awesome cook. And he opened up a restaurant in the strip mall March of 2020. And I don't know if he did it before he opened or immediately after, because he hasn't had people in the restaurant yet. But he made sure that his website worked really well. Got a little bit of press, a little bit of social media exposure. He's been killing it for a year. Curbside pickup and delivery. The Italian restaurant down the street, which is awesome if you go in there, kept their 25% seating for about the last year. I think they're up to 35% now around here. But his website's brutal. Can't order on it. Can't do payment. It's hard to read the menu online. Right? He's got some old PDF. And he's on the verge of going bankrupt. He's surviving on the 20 or 30 drunks that come into his back bar. And a few of them have died from COVID. That analogy works in industry all the way across. Companies that are not investing in technology upgrades are going to die. Why are they not investing in technology upgrades? In some cases, it's bad management. In other cases, it's just a symptom of not having the money to do it. And if you don't have the money to do it in an easy money economy like this, you're in trouble. If your management doesn't get that they need to reinvest in that technology to make their business better, either they're just running out the string waiting for retirement, or it's just bad management if it's a bigger company. So when we pick out companies, we want to make sure that we're looking at that reinvestment. On Monday, we're going to go through about 20 companies. Maybe we might be able to make it through the entire list. We'll see. I feel up to doing a 2-hour call. But the plug and play stock list is actually a little bit more change than I thought it would be. Markets, according to Sentiment Trader, have a historic level of tension right now. I'd point to this chart. This chart measures the positive and negative inputs into the market. And right now, industry breadth is at an extreme. In here, I remember doing it here, and I remember doing it back in here. And people were telling me, Bonnie was talking about this, the sentiment looked good. Well, it looks good until it gets to about this red line. And then it's getting overdone. So you essentially have everything in the market. I've been showing you those relative strength index charts. It's overbought. And what do we know is about to happen? Corporate earnings are either going to stop growing as fast or maybe even come down, depending on how the taxes work. So in the face of less improvement in earnings, can everything stay as overbought? We know that the ratios are way out of whack. Does that mean that market can't go up a little higher? Sure, the market, which is largely defined by the mega caps, sure, it can go up a little further. But we've seen a lot of small caps, mid caps, and other large caps, right? I'll exclude the mega caps, get beat up when there's some sort of really minor event drive something down 50, 60%. Take a look at Cathie Wood's ARK Innovation Fund. Is it down 30, 35%? And that's without Tesla getting crushed, like it probably should. And that's without the US having a digital dollar to compete with Bitcoin, and before there's new regulations on Bitcoin. The reason I pounded the table on Cathie Wood's fund a year and 2 years ago, so that's the right ideas for the most part, but now she's got a ton of capital, a market that's stretched, a couple of key holdings that I think are at huge risk. So I'm looking for other things to invest in. Doesn't mean I won't cherry pick some of her stocks where I agree with her, where I think her buying can drive the price higher. I want to get in front of her a little bit so that as she gets money to invest, she'll push some of my stocks up. But I have dumped a couple Cathie Wood stocks. I did my deeper dive into the companies. I'm just like, these are risky. If you buy them as a basket, I get it. You're just looking for the home runs, and hopefully she can manage the risk. But in an ETF or a mutual fund, the way that those work is the manager's ability to control risk is limited because of their charters and regulations they have to follow. You can do it better. And that's not a joke. You can manage risk better than most professional managers because you don't have to follow the rules they have to follow. That's your edge as an individual investor. So you should be able to manage risk better than them. And then if we can find the right information and analyze it in a way that's useful and correct, then you have another edge because you've eliminated their edge. The way you beat the professionals in investing is you take away their information edge and then you manage risk better than them. Why did I spend so much money on an artificial intelligence to help me out? Because I wanted to get rid of their information edge. I think I've pretty much accomplished it. So for me, just as an investment letter writer, I just have to deliver the information, but there's only so many hours in a day. And I don't want to give you 200 things to think about. I want to give you 20 things to think about. That's enough. So this is the guy that I interviewed, Julian Klimachko. Right now, he's the SPAC king. But he runs the Accelerate ETFs up in Canada. So if you're a Canadian investor, these are some ETFs that you can probably look at buying. Not a lot of it, but a little bit. He has an arbitrage fund, which is based on SPACs. And it's not dissimilar to what Tuttle and Yusko are doing, those other two ETFs that we use here. So he's largely speculating on the IPOs because if they cut a deal that you don't like and you bought in for around $10 a share, you're going to get back around $10 a share because you just redeem your shares. One of the tweets he put out today goes to my idea that liquidity is getting a little tighter. A couple of SPAC IPOs today downsized. Nobody wanted to invest in them. The mania is probably over. So the two ways that I've been telling you to invest in SPACs are right. You buy near the IPO price, SPACs that have good management, the right size pile of money, and the right industry focus. And then the companies that make a good acquisition that you can look at, analyze. And there's more information on a SPAC deal than there is on an IPO. That's true, right? Because the S1 is pretty loaded with information. So a SPAC deal allows you to analyze companies. We talked about a SPAC deal. Topps baseball cards was taken public. People say, so what? Well, they have a CEO that used to run Disney. This is his pet company now, right? Eisen bought Topps, the majority of it. He's the CEO now. But what have we seen that's become pretty interesting? NFTs, those digital things that I still don't even understand. digital rights baseball card images. Maybe that'll be a thing with this company. So Topps is a profitable company. Not a lot of downside risk to this deal. And there's the possible upside that NFTs gain popularity. And we've seen some hype in that market, and I don't know where it's going. But a low risk thing with the potential for big upside, that's what you should always be looking for. Don't look for a high risk thing. Look for a low risk thing that has the, but wait, there's something else. Tesla used to be that type of stock. Today, I worry about it. I truthfully think it's going to get back down to this $400 to $500 range. I said that when it was $800, $900. People said, no. I'll tell you what, there's a possibility Tesla comes quite a bit lower than $400 to $500. I think there's enough love for it that probably doesn't happen until the competition really asserts itself. But the market share penetration of the other companies, even though Tesla set record numbers based on China, you take a look at the market share, they lost. Think that through. So the pie is expanding, their market share is shrinking. So you have to do a math equation and see, okay, how big are they really going to get? When Ford and GM cut their deals with whatever companies it's going to be on alternative energy, SunPower, Sunrun, whoever, they have those national sales forces out there to the dealerships. Is Tesla really going to maintain their lead? Technologically, it doesn't look like it. People like their particular nameplates in many cases. There's something like 60 to 70% of people buy the same nameplates over and over again. Teslas aren't cheap. Everybody else has a tax break too. Going back to the overall market, I do think that my target is up here around 500 on the S&P 500. It doesn't mean I don't think they're going to get back in here somewhere. A low 300s price on the S&P 500 is probable. Under 300 is possible. And way down here to retest these lows, not out of the question. Probably have to be an event of some sort, a shock to the system. But I will say I have quite a bit of faith in the Federal Reserve to navigate a somewhat soft landing. Now, I don't think they can smooth it out perfect. They could, I'd just be 100% long all the time. But I think that probably you're going to see some pullbacks here. This breakout right here past this 1.6, this 1.618 level, it needs to rally hard. And if it doesn't, it's going to pull back. Probably come down to 340s. And then it's just a matter of does it keep going? And that'll depend on the news. Do people's expectations shift? We know that most of the companies are overvalued and overbought, but the market can be irrational a very long time. And that's why you don't go 80% cash. You and I and everyone else aren't smart enough to do that, or lucky enough. Take a look at your individual holdings, pull back where you're supposed to pull back. Keep your highest conviction ideas. Stocks like Barrick and AT&T and Kinder Morgan and Lumen Technologies, I'm not trimming those. But anything that's up 30, 40, 50, 100, 200%, yeah, I'm trimming those. I'm probably trimming them a lot if I can't justify, based on fundamentals, how overbought they are. Somebody was telling me they were selling puts based on a daily chart. You don't want to use a daily chart. You want to use a weekly chart. Weekly time periods. Now, one thing that you can do here is instead of looking at 13 weeks or 14, so the daily RSI is based on 14 days. With weekly charts, at 14 days is 2 weeks. With a weekly chart, I think you can go as short as 8 weeks. And here, that means that the S&P 500 is really overvalued. overbought, excuse me. Value and bought are different. Overbought is a technical thing. Overvalued is a fundamental thing. So based on the weekly chart, 8 periods measured, the last 8 weeks, that's how overbought we are. Now, you can use a longer look back. 14 coincides with the daily charts. And I think a lot of people make this mistake. I think they leave it at 14 and look back for over a quarter. What we know that these markets turn over about every 2 to 3 months. So I would rather use an 8-week look back period because this gives me a head start on the rest of the market. But let's understand what you're looking at. And how easy is it to draw this trend line? Look, what does that tell you? Well, what happened here? Right, lower and lower till it collapsed. I want to use a curvy line here, but whatever. You see the lower lows, lower highs, excuse me. Get that one fit. This was the Federal Reserve, right? Repo market bailout, and then crash. And I'll tell you, this was going to happen with or without coronavirus. May not have happened at the same time, exact same magnitude, but it was going to happen anyway. It's already happening again. Got here, here, here. You're going to get another fall. Does it get this low again? I don't know. If you go way back, you see a lot of times where it gets in here. I do think that that's the most likely scenario as the corrections roll from industry to industry, sector to sector. Again, because it's going to be hard to suck all the liquidity out of the market, right? When the market crashed for coronavirus, nobody wanted to buy. Nobody. But in a choppy market, you're just going to get opportunities to buy things at different times. So prune the things that are overbought, especially if you can't justify the valuation based on future earnings. Then look for other things to buy that are lower risk, but have that one other thing or two other things that could drive them much higher. He's at AT&T, it's Warner. Lumen, they're going to spin off that consumer division that I told you about. The same way that AT&T did with DirecTV, maybe into the same entity. Kinder Morgan, backdoor play on hydrogen, and really no competition to speak of. Because nobody's going to build a pipeline in the next 4 years. Probably not ever again. I mean, seriously. There'll be pipeline replacements, but you're just pretty much done seeing pipeline development in the United States. Barrick Gold, profitable. They're reopening a mine, actually. Buying back shares, paying a dividend that's increasing, improving balance sheet, right? That's a great shareholder yield idea. So if you haven't listened to the Meb Faber interview I did, listen to that. Talk about shareholder yield. That's what you should be looking for. Company with improving fundamentals and management that figures out a way to get that money into your pocket. Similar things to be seen on QQQ. Mega caps, haven't done all that well since September. We probably have a correction coming linked directly to the tax increases, I think. Here's your 14. Here's your 8-week look back. Not overbought, so you could get a little rally here, especially as people look for what they consider to be safer havens. Or if you take a look at Apple, that trend not pretty clear. I think we're going to get Apple around $100 a share. So we'll see. I would love to buy it around $100 a share because it's freaking Apple. And again, there is no reason on earth to own a bank stock. None, zero, absolutely none. Apple and Microsoft pay a dividend. They buy back shares. They have more money than any bank in the universe, less liability, and they're tied to the economy in a better way than any bank is. Because bank gets all the bad deals too. When you're buying a bank, you're basically buying an S&P 500 fund that's getting skimmed by management, right? Because banks invest across the economy. And every now and then you can find a small or regional bank that makes some sense. But any of the big banks, JP Morgan, Bank of America, any of them, dump them, dump them, dump them. Because interest rates aren't going much higher. And the reopen trade has essentially happened already. And now we're about to go through the long slog of getting back to normal. That'll probably take a couple more years. Interestingly, I saw somebody talking about a labor shortage at some point. And the argument from some idiot at some think tank, some right-wing think tank, was that people just don't want to work. I've never heard such a pile of shit argument in my life. Look, will people take the free money while it's out there? Sure. But we just started getting vaccinated. As the economy gets back to normal, people want, which is just part of the human condition, to live a better life. Life, liberty, pursuit of happiness. We're probably not going to have a labor shortage soon, but it was an interesting argument because in the long term, we need automation to keep from having a labor shortage. Why is that? With so many baby boomers retiring and the birth rate so low. In the very long run, if we really had a labor shortage, if robots stopped evolving, if AI stopped improving, if machine learning stopped happening, we could see inflation. But all the people who talk about inflation have been wrong for a very long time, like 40 years. And they're going to be wrong probably another 40 years. Until the demographic situation changes, deflation is the boogeyman. You might get your short-term bouts of inflation that are more than what it was recently, but we're not going to see 10% inflation. You're going to see 2, 3, 4, 5%. And when that happens, it'll happen for like a year. Then it'll come back down. The natural forces of demographics can't be defeated. Can't be. They can be offset with counter-cyclical policy. When counter-cyclical policy pushes inflation up, what's the next logical step? Reverse the counter-cyclical policy, right? Just take the other direction, other side of the bet. If somebody says PPI came in at 1% today, whoop-de-doo. I'm actually old enough to remember when PPI hit double digits. And I remember some gasoline lines. Look, the economy is going to get better and better and better because supply chains are moving, because the new policies in the government are focused on sustainability and labor and infrastructure and all the sorts of things that go into rebuilding the world. Maybe they're rebuilding it better, maybe they're not, but they're building. I think they're rebuilding it better. And we're going to make money on that barbell because of what's going on. All right, everybody have a great day. And I will have the plug and play out this weekend. It's almost done. Additions and subtractions to VSL. And I've got somebody working on putting all the trades in on a monthly lag to the VSL as well. So we'll be tracking the trades as well to make it a little easier on you. All right, have a good weekend.